A heated debate is unfolding in the world of tax and corporate policy, and it's time to dive into the heart of the matter. The issue at hand is a potential loophole that could impact the tax obligations of some of the biggest corporations, and it's got many Democrats concerned. 9 Democratic senators, led by the renowned Senator Elizabeth Warren, have voiced their worries about a proposed change to the Corporate Alternative Minimum Tax, CAMT. This change, they argue, could create an unintended consequence, allowing certain companies to pay significantly lower taxes than intended. Let's break it down. The One Big Beautiful Bill Act, OBBB, brought about a significant change in how research and experimental, R&E, expenses are treated. It restored full, immediate expensing for domestic R&E costs, reversing a previous rule that required these expenses to be amortized over 5 years. This change also applies to expenses incurred during the transition period from 2022 to 2024. Here's where it gets controversial. Some trade groups, like the National Foreign Trade Council, argue that this interaction between the OBBB's R&E expensing provisions and the CAMT could lead to unexpected results. They suggest that the reinstatement of full expensing in 2025, combined with the amortization from previous years, creates a situation where taxable income decreases without a corresponding impact on adjusted financial statement income, AFSI. CAMT, in simple terms, is a 15% minimum tax applied to the AFSI of large corporations. Its purpose is to ensure that these corporations pay a minimum tax, even if their taxable income is reduced due to deductions or credits. However, the proposed change, as outlined by the National Foreign Trade Council, would allow taxpayers to adjust their AFSI for CAMT purposes, potentially undermining the very purpose of this minimum tax. Senator Warren and her colleagues are staunchly against this proposed carve-out. They argue that it would create a massive new tax loophole, allowing billionaire corporations to pay tax rates lower than 15% on the income they report to shareholders. The lawmakers highlight the significant amount of retroactive R&E expensing available under the new law, which could result in corporations accelerating $67 billion in tax deductions in 2026 alone. These deductions, they fear, could drop corporate tax liabilities to dangerously low levels, with CAMT being the only safeguard. But here's the part most people miss. The shift back to immediate, full R&E expensing had bipartisan support. As Andrew Lautz from the Bipartisan Policy Center points out, both parties would have had to deal with the complexities of this transition. Lautz also acknowledges that while the acceleration of R&D deductions cannot directly incentivize new R&D investment, it could indirectly support it by freeing up capital. Senator Warren, however, remains unconvinced. She believes that retroactive expensing fails to encourage economic activity, as the research has already taken place. In her view, these retroactive tax cuts could represent a substantial cash infusion for corporations, potentially leading to higher executive pay or shareholder benefits in the form of buybacks and dividends. In her latest letter, Warren and her colleagues have called for a response from Treasury leaders by December 17, seeking clarity on the potential regulatory changes and their impact on the national debt. They want to know how many companies would benefit from subtracting retroactive R&E expenses from AFSI, and the potential consequences for the country's finances. This debate highlights the intricate nature of tax policy and its potential impact on the economy. It's a complex issue, and we'd love to hear your thoughts. Do you think the proposed change is a necessary adjustment or a potential loophole? Should the government intervene to prevent this? Or is it a natural consequence of the tax system? Let us know in the comments.